For the last 18 months, I've put my own money on a mission, spreading it across the three giants of the brokerage world: Charles Schwab, Fidelity, and Vanguard. I wanted to cut through the marketing noise, the slick commercials, and the endless online debates to find out which platform is truly the best for the average American investor. After a year and a half of real-world testing, making trades, holding cash, and navigating their systems, the answer was shocking. Only one of them was genuinely worth it. Most people believe the myth that in the era of free trading, these brokers are all the same. Since they've dropped commissions on stocks and ETFs, the assumption is that it doesn't really matter where you park your money. That assumption is not just wrong, it's dangerously wrong. After 18 months of active use, I discovered free trading is a masterclass in marketing illusion. It's a shiny object designed to distract you from the massive invisible costs and benefits that dramatically impact your portfolio's long-term growth. One of these trusted names is systematically costing its clients a fortune in ways they don't even see, turning a blind eye to their customers' best interests in favor of their own bottom line. This isn't just my opinion. This investigation is based on digging through their dense fee schedules, their mandatory SEC filings, and the real-world performance of my own cash. In this video, we'll stage a 5-round showdown covering what actually matters to your bottom line. Round 1 is the hidden cash drain. Round 2 is the trading arena. Round 3 is the product universe. Round 4 is the support showdown. And finally, we'll reach the final verdict. By the end, you will know with certainty which platform deserves your money and your trust. Let's dive straight into the single most important, yet criminally overlooked feature of any brokerage account. What happens to your uninvested cash? It doesn't just sit there idly, it gets automatically swept into a default holding. The interest you get can mean the difference between earning hundreds of dollars a year, enough for a round-trip flight or a new smartphone, and earning next to nothing. This is where the first bombshell drops, particularly on Charles Schwab. When you deposit cash, the broker sweeps it into a fund to earn interest. The question is, who keeps the lion's share of it? At Vanguard, your cash is swept into their federal money market fund, yielding a very healthy 5.28%. Over at Fidelity, it goes into their government money market fund, yielding a similarly competitive 4.97%. In both cases, you are being paid a fair market-driven rate on your own money. And then we have Charles Schwab. Your cash is automatically swept into their bank sweep feature, where it receives a pathetic 0.45%. Let me repeat that because it deserves to sink in. Vanguard, 5.28%, Fidelity, 4.97%, Schwab, 0.45%. That isn't a typo. This is a conscious business decision. Let's frame this in real-world terms. On a $10,000 cash balance, you'd earn about $528 annually at Vanguard and $497 at Fidelity. At Schwab, you'd earn just $45. You are losing almost $500 a year for no reason. It's not a direct fee, it's a hidden tax they put on you by not paying you what your cash is worth, and they are pocketing the massive difference. This is a core part of their business model, a multi-billion-dollar profit center built on the assumption that you won't notice. This single issue could be an instant disqualifier for Schwab, as it fundamentally contradicts their marketing as a client-first, low-cost leader. This philosophy also appears elsewhere. Fidelity's margin rates are consistently lower than Schwab's, meaning it costs you less to borrow. And if you ever decide to leave, Fidelity charges you nothing to transfer your account. Schwab hits you with a $50 exit fee, and Vanguard charges a shocking $100, making it feel like you're being penalized for taking your business elsewhere. For round 1, the verdict is clear. Vanguard and Fidelity treat your cash with respect. Schwab, with its abysmal cash sweep rate, comes in a distant last. It's a massive, self-inflicted wound that undermines its claim of being a low-cost leader. Now, let's move to the experience of buying and selling. This is about the power of the tools at your disposal and the fairness of the system working behind the scenes to execute your trades. At the absolute pinnacle of trading platforms sits thinkorswim, which Schwab acquired from TD Ameritrade. For serious active traders dealing with complex options strategies, futures contracts, or advanced technical analysis, thinkorswim is the undisputed king. It's powerful, it's complex, and it offers professional-grade features like the on-demand function that lets you backtest strategies against historical market data. For the top 1% of traders, it's the primary and perhaps only reason to be at Schwab. But for the other 99% of us, Fidelity shines brightly. Its web-based platform is the best all-around trading experience, clean, intuitive, and surprisingly powerful. It seamlessly integrates advanced charting, detailed stock research from over 20 third-party providers like Thomson Reuters, and a user-friendly workflow. Its only major weakness is its clunky desktop platform, Active Trader Pro. But for the vast majority of investors, Fidelity's web ecosystem is the clear winner. Then there's Vanguard. Its platform is not for traders. It's intentionally primitive. The user interface feels a decade old, and advanced tools are non-existent. This is a feature, not a bug. Vanguard's entire philosophy, inherited from its founder John Bogle, is to encourage long-term passive investing by making frequent trading difficult and discouraging market timing behaviors. For a true Boglehead, this is perfect. For anyone else, it's a constant source of frustration. But one universal blind spot all these brokers share is tracking your true performance. Their built-in tools are surprisingly bad at this. They often ignore dividends, can't handle currency changes on international stocks, and are useless for tax season. That's why I personally use a tool called ShareSite. It automatically tracks every dividend, handles foreign currency conversions, gives you clear diversification reports, and makes tax reporting painless. It's the dashboard your broker should have given you. Using my exclusive link in the description, you get 4 months free on an annual plan. Now, beyond the user interface, the platform you see is only half the story. The other half involves a controversial practice called payment for order flow, or PFOF, where a broker sells your order to a large market-making firm instead of sending it directly to an exchange. It creates a potential conflict of interest. Charles Schwab relies heavily on payment for order flow. In contrast, Fidelity and Vanguard do not accept payment for order flow for stock and ETF trades. Their systems are designed with the singular goal of getting you the best possible execution price, period. This removes any question of whose interests are being prioritized when your trade is routed. The verdict for round 2 is nuanced. For elite, professional-level traders, Schwab's thinkorswim gives it the edge. But for the vast majority of investors who want a powerful, user-friendly platform and an execution model that is structurally aligned with their best interests, Fidelity is the clear winner. What can you actually buy on these platforms? In the modern landscape, product flexibility is crucial, revealing a massive divergence in philosophy. While all three cover the basics like stocks and ETFs, the differences emerge in 3 key areas: fractional shares, international access, and cryptocurrency. First, fractional shares are a game changer. Want to invest in a high-priced stock like Microsoft but don't have over $500 for a single share? This feature allows you to buy just $50 or $100 worth. Here, Fidelity is the undisputed champion, offering them for over 7,000 stocks and ETFs. Schwab's offering is bizarrely limited to companies in the S&P 500, and Vanguard only allows them for its own ETFs. Fidelity wins by a landslide. Next, international investing. If you want to buy a company's shares directly on a foreign exchange, like Toyota on the Tokyo Stock Exchange, both Schwab and Fidelity offer this capability. Vanguard does not, limiting your international exposure to US-based funds that hold foreign stocks. The biggest philosophical divide is cryptocurrency. Fidelity has leaned in, offering direct trading and custody of Bitcoin and Ethereum. Schwab has taken a more tentative approach, allowing exposure only through the various SEC-approved Bitcoin ETFs. And Vanguard is actively hostile. They not only refuse to offer crypto products, but have gone so far as to block their customers from even buying those ETFs. Their stated reason is that they view crypto as a speculative asset that runs contrary to their philosophy of long-term investing. Whether you agree or not, it's a direct limitation on your investment choice. The conclusion for round 3 is inescapable. With its industry-leading fractional shares, direct international access, and forward-thinking embrace of digital assets, Fidelity offers the broadest and most versatile product shelf. When your money is on the line, the quality of customer service is paramount. In this round, there is one clear winner, one struggling giant, and one undeniable loser. The gold standard for service in the brokerage industry is, without question, Fidelity. They offer 24/7 phone and live chat with US-based representatives. In multiple tests, wait times were consistently short, and the agents are well-trained, professional, and empowered to solve problems on the first call. Whether you need help understanding a complex tax form late at night or need to report a suspicious transaction, you can reach a competent human being immediately. It is a premium service experience, free of charge. Charles Schwab also offers comprehensive support, including a large branch network for in-person help. However, since the massive TD Ameritrade merger, their service quality has been noticeably strained, with longer hold times and more frequent escalations reported by users. The integration has been a source of significant friction, with many former TD Ameritrade clients feeling the new website is a downgrade and that key features were unceremoniously lost in the transition. That brings us to Vanguard, whose customer service is at the bottom of the barrel. Support hours are limited, there is no branch network, and phone hold times are notoriously long, sometimes stretching over an hour. Their low-cost, digital-first model has come at the direct expense of the human support element. If you ever have a complex issue like rolling over a 401k or settling an estate, prepare for a deeply frustrating and time-consuming experience where you feel more like a case number than a valued client. The verdict for round 4 is the most clear-cut of all. Fidelity is the undisputed champion of customer support. Schwab is trying but is hampered by its merger, and Vanguard is simply not in the game. We've put all 3 brokers through the ringer. Now it's time to answer the final question. Which one is worth it? The truth is, they are built for fundamentally different people, and a deal breaker for one investor might be irrelevant to another. Vanguard is for the die-hard, passive, boglehead-style index fund investor. This person buys a few low-cost ETFs and plans to hold them for decades. For them, absolute lowest cost is the only thing that matters, and they are willing to sacrifice platform quality and customer support to get it. Charles Schwab is for the sophisticated active trader. This person needs the professional-grade power of the thinkorswim platform for complex options or futures and is willing to meticulously manage their cash to avoid the platform's other glaring flaws, like the atrocious cash sweep. That brings us to the winner for the vast majority of American investors, Fidelity. Fidelity wins because it has no major deal-breaking weaknesses. It delivers excellence across the board. It combines a top-tier web platform with industry-leading customer service you can actually rely on. It has a client-friendly, high-yield cash sweep that respects your money and a superior order execution model with no PFOF on equities. Finally, it has the broadest and most forward-thinking product shelf. It is the most versatile, well-rounded, and client-aligned platform of the big 3. It is the safest choice because it minimizes the compromises you have to make.